Hello, welcome. This is a long-awaited video on the use of Trader.io as a tool for viewing positioning and liquidity metrics to make sure I'm making better trading decisions essentially. So this is very much a supplementary tool I use once prices come into regions I'm interested in trading around to identify whether I'm making good decisions based on positioning and liquidity as we come into these regions. So the first thing I'm going to look at is open interest. So we're obviously familiar with open interest, and most of us have probably used tools like Velo Data or Coinalyze in the past, perhaps, to get a view of open interest on a candle by candle basis. So here I've got the 4 hour and I've got open interest presented on a coins basis. And this by itself is useful, right? So it's aggregated and I can see where there are big increases in open interest relative to price. These might be regions where I'm looking to fade. For example, if I just look back, just visually I can identify it. So I can see here we had a bit of a ramp up in price. Wrong tool there. So from this low, for example, up to this high, price increased 6%. And on a coins basis, price increased by around 9% here. So there's a bit of a dislocation here. Yeah, by about 9%. So a bit of a dislocation here between the increase in price and the increase and the delta in open interest, which would be suggestive of directional longs getting a bit too excited, particularly on this candle. As you can see, we pushed into this high, had a big increase in open interest. And ultimately, this led to a big unwind to the downside as these positions get forced out of the market. So we can use open interest as a tool. For example, I could say, okay, we've clearly got a ceiling in OI here as well, right? At this 200K level, essentially, the market is not sustaining any positioning above that level. And therefore, every time it comes in and tags this level, this might be somewhere I'm looking to make a decision. So for example, this was the example we just looked at. Clearly, market's not sustaining this positioning, so on and so forth. But on its own, it requires quite a lot of manual effort to delve into the data and see where we've got these dislocations on a sort of case-by-case intraday basis. So one of the great advantages that Trader has now is that I can present this metric in RSI format, which will very quickly enable me to see whether open interest is overbought or oversold on a candle by candle basis, essentially. So I've got here a fresh template, 4 hour chart. The first thing I'm going to do is just bring up open interest so we can see that data. It's aggregated. By default, it aggregates everything, so I get all of the quote assets and all of the exchanges. I'm just going to deselect these two quote assets, FD, USD, and TUSD. These are heavily manipulated pairs, and the volume is generally quite low in any case. And in terms of the exchanges, I'm just going to deselect Deribit, Huobi, and Qcoin. Those are where most of the volume is, and there's a lot of sort of wash trading and nonsense which goes on, arguably on Huobi and Qcoin in particular. So I'm just going to deselect those for the purposes of this. And that gives me my open interest aggregation. And similarly here, I can see that we've got potentially big ramps in open interest coinciding with local tops. So for example, here we saw a 6% increase in price and a 15% increase in OI. This is measured by dollars, obviously. So, a big dislocation between the amount of effort being put in on the long side in terms of number of directional longs added on this up leg versus the price impact. So potentially that is therefore going to be an interesting area to fade. And similarly, again, we can see that we have a bit of a ceiling here where, open interest is unable to get above this 18 billion area, which coincided with this top. Obviously, here we did push above and this score got flushed out, and then this top here as well. So, by itself, it is useful, but as I say, it requires that manual effort. It requires me to go in and say, okay, where is there a potential ceiling? And then to potentially delve in on a candle by candle basis and look at the dislocation between price and OI, which is difficult. I don't necessarily want to be doing that all day. I just want to be identifying when when I maybe want to be fading on an open interest positioning basis, when prices come into an area I'm interested in doing business at in the first place. So I mentioned it earlier, but I can convert this into an RSI metric within Trader. So all I do is go options, add a metric. I get my source, so open interest aggregation. That's the source data I'm using. Chart time frame, market types, spot and perpetuals. It's obviously it's just open interest, so it's irrelevant. It's going to include what's there. Quote assets, little settlement assets. Sure, that's fine. And then I just want RSI. Add the chart. Okay, so now I've plotted this data in RSI format. And so on a relative basis, I know that when it moves into overbought or oversold territory, I've got a big change in open interest. And this may be, therefore, where I'm interested in either fading a big puke to the downside or fading an increase in open interest to the upside. And sure enough, even without adjusting this in any way whatsoever, I can see that we've got a local low here on a flush of open interest into this level, which would have been very difficult to detect just visually from this. So it moves into oversold territory, and that was a local bottom. We get overbought here, and we get a flush, local top. We get very overbought here, and this was a significant swing high, leading to this unwind to the downside. And the next local low was highlighted here by oversold RSI, and similarly this move into overbought territory here. So very quickly I can see how powerful this is on the 4 hour. Now you can see that these swing points didn't necessarily quite push into overbought territory or oversold territory, and therefore just to capture this more easily, I'm just going to move the points to 65 and 35. And that way, I'm just making sure that every time it does move over into overbought or oversold territory, it's just that bar is a little bit lower. So I'm not missing anything. So at this point, I can really just remove this and just work with the open interest on an RSI basis alone. Similarly, yesterday we got this dump into 75k area, and open interest really got very oversold. I wouldn't have been able to pick this up just using open interest alone. So it's a really, really powerful metric, right? And that's why I've been leaning on it so heavily lately. Okay, so that's it. That's really it. On a 4 hour basis, it's going to give you stronger signals for potentially swing trading. So holding these positions for a longer period of time. Most of these rotations are taking a number of days to play out. This one, okay, just a day, just a bit of a sell-off there. But this low, this move played out over almost 2 weeks. So on a 4 hour, on a higher time frame, I would use this more for swing trading. It's going to give you stronger signals. It'll probably take longer to play out. This move to the downside, for example, played out over a couple of days. And this move back up again over a couple of days. So that's open interest in a nutshell. I'm looking to fade big changes in open interest, either directional longs getting very excited. Directional shorts could get very excited, right? We could see a big increase in open interest into a low. For example, I don't think there's anything here. It's more rare, let's put it that way. But it can happen. So big changes in open interest are where I want to be positioning, either buying into liquidations as people get forced out of the market, or fading big increases in open interest as long as get too excited at an extremity. And that's really how this RSI metric works. Right, hopefully I don't need to explain RSI. I'm not going to go into it in this video, but it's a measure of the rate of change of an underlying data point. And that's why it's powerful in this context. So that deals with the positioning side of things. So that's one data point. Now, what about liquidity? So one of the key features of Trader.io is its ability to aggregate order book depth. So This is the default metric, order book depth aggregation. I believe this is it anyway. I might need to change my metrics here. I just want spot. In this case, I want 10% away from price. It doesn't particularly matter how I present this because I'm going to change it to RSI anyway. There we go. I wanted the delta. So there we go. So I've got order book depth aggregation delta, so I can see the book skew essentially. 10% away from price. In this case, I've changed it as I'm looking at the 4 hour on higher time frames to 0 to 10%, and I'm just looking at spot. I'm only interested in the spot books on higher time frames. They give me stronger signals for intra-week swing trading purposes. And again, I'm just going to deselect FD/USD and TUSD, and I'm going to deselect, well, in terms of the exchanges I'm going to use for spot, Binance, don't really care about BitMEX, Bitfinex, yes, Bitstamp, yes, Coinbase Pro, don't really care about any of these. Kraken, we can keep. Qcoin, not really, don't really care. OKX, sure, that's fine. So, select whichever you want, but these are the ones I would run with: Binance, Finex, Stamp, Bybit, Coinbase, Kraken, and OKX. As we move down this list, they're going to make less difference. Arguably, Binance, Bybit, Coinbase are probably the three most important, and arguably Kraken. Okay, so that gives me the order book depth aggregation alone, and I can see, that when we get big spikes in depth aggregation, these tend to coincide with swing points on the chart. So, up here, clearly the depth moved negative, and this was a local top. Likewise here we had a local bottom on positive skew. But again, it doesn't, alone, this is not really a particularly helpful way of viewing the data. So what happens if I convert this to RSI again and see that rate of change? Can I use that to give me stronger signals? The answer, in my opinion, is yes. So again, I just go to add a metric, and here I'm looking at order book depth cumulative aggregation. We just want spot. I'll change the settings on this afterwards. RSI, that's fine. I'm going to add that to the chart. Doesn't want to add for some reason. Depth. So I want 10% because we're just looking at that spot data. If I'm looking at lower time frames, I'll reduce that and include perps as well. But for the purposes of this high time frame view, I'm looking at 10% depth and just spot. So there, add that to the chart. Okay. Now let's just make sure I've got this set up as I wanted. I'll keep that on for now. So I have to go back in here, deselect the quote assets I don't want, and I just want spot. That's fine. So Binance, these aren't going to be included anyway because I'm just looking at spot. We can include those, that's fine. No, 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 no. Okay, and again, in this instance, I can see that we don't ever get into this 70 to 30 region or outside of the 70 to 30 region, and therefore, again, I'm just going to adjust these points to 65 and 35. You could even make the case for going 60-40 on this, I think. That would be quite a reasonable thing to do. Let's just try that. Yeah, that's probably a better setup. So let's just double check I got this set up as I wanted it. Spot only, don't really need these, not going to make any difference. So yeah, that's fine, that's fine. Okay, so now I've got a view of the rate of change of the book depth versus price, and with open interest presented in the same way. Now, what I can see here is that, well, here I can see local lows generally tend to coincide with overbought book depth, local lows with oversold, local highs rather with oversold book depth. So at this point here, at this point here, I've got low. At this point here, I've got a high. Similarly here, across these lows, we get some divergence. This high, the book depth RSI has moved oversold. This high, really strong signal, right? So we get very overbought RSI on open interest and very oversold on book depth. And I just wouldn't have necessarily, excuse me, I'm going to sneeze. I wouldn't necessarily have viewed this ramp in book depth on its own as particularly important. So viewing it as RSI just makes it visually much clearer and much easier to identify when we've got an anomaly. Likewise here, book depth gets very overbought and we print the local bottom. And similarly here, we've got an anomaly and we print a local top, or here rather. Clearly that this is on the sell-off that this changes. So at the local top, after we swept the high, we had negative book skew, and at the bottom yesterday, and the reason I was very confident in taking the long in the end, even though it was a short-term trade, was the books were very supportive in this area, on this after this leg down. So, having converted, quite not inactionable but difficult to read, difficult to interpret data into an RSI, I've converted these metrics into something very actionable and very straightforward to read, and I can use open interest RSI in conjunction with the book depth RSI to really strengthen my conviction and give me potentially just reasons to enter at these areas. So, for example, if I look at the setup yesterday, at the lows, I've come into the trading view here. So price had traded down into the 365-day rolling VWAP and made this low. And I always talk about this momentum point, right? We want to wait for the shift of momentum. I got the signal on this 4-hour candle. So the signal came at 5 a.m. So it would have been on the 5 to 9 a.m. candle, which was between here and here, right? This is where we printed the low. So once that candle closed, perhaps I'm then looking for longs. We get the shift in momentum, right? So we get momentum reversal. We left behind the buying imbalance. This is where I got into the long. And I took profit pretty quickly, right? It was just a quick trade. But the point is, it gave me good reason to get into that position in the first place. So I knew I'd come into a region of contextual significance, given that we're trading around the 365-day rolling VWAP. But had I not had this signal, I wouldn't really have had a good, strong reason to enter. Okay, so if the books have been chasing this down, for example, we wouldn't have seen a big change in RSI. If we hadn't seen a big puke of open interest and shorts were piling in, directional shorts are still entering against longs, maybe this wouldn't have given me a signal either. So, those two points of confluence in terms of positioning and liquidity are always going to be quite powerful. So that was the reason I was willing to get into that trade yesterday. Okay, so that's positioning and liquidity, and that's kind of the key thing. You can use this on lower time frames as well. So I've shared some templates. I won't go over them. It's the same thing. I just adjust the parameters slightly. So on lower time frames, I'll look at the same thing in terms of OI. And on the book depth, I'll reduce the depth to 5% and look at spot and perps. And that generally gives pretty strong signals around the 60 and 40 levels again. So, this is not a tool to use in isolation, but when price is coming into a region you've identified as important, and we get these signals, it can give us a reason or filter out taking that taking that trade. So it's a filtering mechanism essentially, and a very powerful one. Okay, so what else do I like to look at here? So the other couple of pieces of the puzzle that can be useful, liquidations, so aggregated liquidations, and again, I can see this on a relative basis, which is fine. And generally, the anomalies in terms of licks tend to be quite clear because you'll go long periods where you won't see many liquidations. And then a big liquidation spike is generally a reason to start thinking about taking a position, either shorts getting taken out of the market as we had here, or longs as we had here, for example. But again, just converting that into RSI, that's it. Okay, so, well, we can use any size really because we're converting it to RSI, so that gives us the metric, and then again, I'm just going to convert this to 60 and 40. We'll just put the overbought, oversold areas at those levels, and we can see again, it gives us an extra point of confluence. Certainly versus liquidity and positioning is less important for me, but big spikes are important, right? Big spikes in licks. So on and so forth. And then finally, something that's potentially useful is funding rates. I won't convert that to aggregation or to an RSI metric. Probably take these out again, deselect these. Okay, so I've created and shared some templates on these metrics. The point I would make here is that this is really a mean reversion tool to be used during mean reversion. When the market is in a strong trend, it's going to be less useful, and so there is a discretionary element to this, right? So if I go back to the trend we had in early November after the elections, it would have probably given some false signals. So let's take it from this point on the 4th of November. Okay, so we broke from value around 70k, and this was the start of the impulse, and obviously we trended up for about 3 weeks or so before we started to form a new range. And so what I can see here is that, initially I probably got a sell signal here, right? I moved into this heavily overbought area, order book depth became negative, but we just had very aggressive buyers as we broke into this new trend, and it ended up with obviously shorts just getting completely blown out here, and then get another signal here, almost get a signal here, not particularly strong. Here I do get a signal, but really we're just compressing before more upside. So my point here is that you need to use this with caution and with sympathy to the current market conditions. So if the market is trending, you need to be much more cautious about where you're taking these signals, because a very aggressive trend will just nullify what's going on here and make it just completely irrelevant, really. If you have a lot of takers and strong takers that aren't able to stand in the way of, or rather that the passive hand is not able to stand in the way of, then liquidity and OI metrics become largely irrelevant, and it can just continue irrespective of what you're seeing in terms of the data here. So where did it start to become relevant again? Well, we get this huge spike in funding here. So here we get clearly a very big anomaly, and this is where we really started just to slow down and form this range that we've seen over the past few, or between December and February at least. So here we get a huge push in terms of open interest, in terms of the book depth, and in terms of short licks. And this is where we really just started to range, and from here on I would say it became more of a useful tool going forward. So again, open interest, bit of a divergence here across these highs. And from there on, it's been a very powerful tool. So it's something I've been, using for a couple of months more frequently, and trying to integrate it more into my day-to-day thinking. And it is incredibly powerful. It has been working so well. So I've waited a bit of time before producing this video because I wanted to make sure I'd vetted it properly before sharing. But the signals it's given over the past few months have been very good, and while they continue to be so, I'll be continuing to lean on it. And I think in a range-bound market, it's going to continue to give strong signals. If we trend in either direction, then yeah, you don't want to be leaning on it so heavily, obviously. And as always, it's not something just to trade blindly, right? You don't just want to be blindly shorting, even though it probably would have worked. You don't want to be blinding and shorting, longing and shorting every time you get a signal in one direction or the other. You still need to be mindful of momentum and where we're looking to trade, right? So I think that's all I have to say on this. I've shared a couple of templates, both one like this for the 4-hour and another one for the 15-minute, which includes perpetuals in terms of the order book depth, and just tweaks the settings slightly, but feel free to have a play with those settings. There's no right or wrong answer here. It's just a visualization of the data and the rate of change, which makes it very easy to identify points at which the market may be at an inflection point. That's it, guys. So pretty straightforward one, pretty quick, and I'll see you next time. Cheers.